Welcome back. You're still watching The Money Show on ET now. Let's talk about an interesting survey that Scripbox had carried out just a couple of weeks ago, and they've had a whole host of revealings and a whole host of discovery when it comes to women investors and the respondents whom they asked a host of questions. Women are recklessly cautious when it comes to saving, as nearly 58% prefer to park their money in either fixed deposit, PPF, or letting it lie in their savings account, according to this survey. Well, this is just one part of it, one of the key findings of the survey. Let's chat with the management of Scriptbox to understand better about the trends revealed, about the investing practices that women follow according to their survey. Ashok Kumar, CEO and co-founder, joins us right now. Ashok, hi, good evening and welcome aboard. Your survey says now that women save their money but they don't invest it. Where is their money then?
Like what my mother also tells me, either in gold or fixed deposit, and those two are the most common and popular instrument. And of course, real estate is the other one. And unfortunately, all these instruments don't beat inflation. But I think one draws comfort of safety because that's what we've been told and brought up, right?
So Ashok, then tell us, why do you think women prefer to stay away from equities?
I think there are two reasons. I think one, there is a lack of knowledge and understanding. Unfortunately, the current narrative in all the magazines and news channels, I must say, is a little bit jargon filled, which we found that it becomes intimidating for them. And one of the approach, for example, a company like ours, Scriptbox, has taken is de-jargonize the whole conversation, make it easy to understand, so that it becomes easier for anyone to understand, especially women as a segment. And the second thing is obviously market keeps going up and down. Often that kind of risk aversiousness and the perception of risk is also we found is pretty high. Those two are the primary reasons why they keep the money in fixed return instruments and not in the market linked instruments.
So this risk aversion which you just mentioned, how does it hurt the money earning potential?
Obviously, I think saving and investing are the two sides of the same coin. Saving helps to meet the short-term goals like emergency, any medical emergency or any job loss, etc. Whereas when it comes to long-term, investing is better. Investing is the only way you can multiply your saving. And why you need to invest? Clearly, long-term goals such as children's education and retirement. I think they are about 10, 20, 30 years away. B, I think with the growing inflation, it has to be kept in inflation beating instruments. And such instrument today is only market linked products, and mutual funds is a safe retail product to go with. And that's what I think we have been sort of attempting to solve for India as Scriptbox.
Women are risk averse, Ashok. Do they adequately at least insure themselves?
I cannot say with certainty, but what I can tell you is that based on what you've seen in our own platform, for example, we have 28% of our customer are women, and I am told that is twice of what industry average is. And because of that, we have a lot more insights on their behavior. What we found is that once they understand the concept and the tools and how can go about investing, we found them that they're comfortable investing in market-linked instruments. And one brief insight on the insurance is that I think insurance, there is no definitely separate behavior when it comes to male and female. But on the investing, I think definitely the risk aversion, perception is a little higher in women.
Okay, so what advice would you like to give to all the women out there who have a good amount of corpus or savings lying around in their bank account?
I would definitely say, just like the way I think there is a lot of talk about health related fitness, one has to take control. I think it is important to kind of take control of your finances. I think the starting point for that is educate yourself. And a platform like ours kind of helps you educate and also help you calculate what kind of needs and the size of budget you need to plan for the future. And that's very clearly, our platform provides practical and actionable insights. And that's something I think they should make an effort to learn. And once you learn, what we found is that you become very comfortable investing.
All right, Ashok, pleasure chatting with you and great getting to know the trends that are emerging and how women are risk averse. What are the various avenues they prefer to park their money in and a lot more. Thank you for joining us once again on The Money Show. But as bulls take charge, and a host of other developments are happening in the market as we speak. We're in the thick of earnings and lots of numbers being delivered, management commentaries trickling in, etc. Here's some views that we would like to get in. Sensex is also extending record highs, and at Nifty has conquered Mount 12K. Here's Madhusudan Kela, Harsha Upadhyay. Let's listen into what exactly is their perspective on how to play this kind of up move that we're witnessing in the market. We'd leave you with that on The Money Show today. Thank you.
What I am really keenly watching for is that first real strategic disinvestment. Does it happen to a private party, whether it is a foreigner or a local company? And I think that will rekindle a lot of confidence among market players. Over the next 5 years, you will see a lot of these small and mid-cap companies change management hands. So there will be strategic value which will come in some of these small and mid-cap companies. My pick will not be these expensive names. Can I go and buy a finance company at 6-7 times book value? It will make money, as I said, but that's not my bet. So I would much rather bet on a company which I feel will survive through this bear phase, and hopefully in the next 3 to 5 years time keep my capital intact and make me some superior return.
Sentiments have improved and the liquidity has also improved post the tax rate cut announcements. Having said that, the fundamentals will take time to really start showing better numbers. So to that extent, I think it's going to be a consolidation phase. One needs to be cautious that it will take time for fundamentals to improve, and hence look at it as more of a investment phase rather than trying to really take more risk and look for short-term gains. Mid and small cap basket is clearly giving more relative valuation comfort, and that's where you will probably end up making more money than the large cap over the medium to long term. We have invested quite a bit of our portfolio corpus into chemicals over the last year or so, and continue to remain very, very positive on this space. We do own insurance companies at a point of time where some of the lending businesses have got completely disrupted. I think from a penetration perspective and what kind of growth trajectory can be there for some of these companies over the long term, there is absolutely no debate. So one needs to be little cautious about the valuations, but otherwise I think these are very good businesses to be invested into. Slowly the private capex should also come up, not immediately, but once the capacity utilization levels will move towards the 80%, which may take maybe 24 to 36 months. But until then, there is enough economic activity that is happening in the country backed by the government capex, and that's what is going to drive some of those demand numbers for core sectors in our opinion.